secret to master Nifty trading, what Nifty is all about, and how you can trade successfully in Nifty. So these are the specific areas of coverage. First is that why do people find Nifty trading difficult? That's one. So I'll talk about that. Then I'll talk about the right way to trade in Nifty. And then I'll talk about the tools that give you an edge in Nifty trading. What are the tools that you can use to trade Nifty well? And lastly, I'll talk about making the right trade. How do you make the right trade? So specifically, it's going to be with some practical examples and also some specific strategies, as well as what are the do's and don'ts when you're trading Nifty. So once we get into Nifty, why do we find that many people say that Nifty trading is difficult? Now, I'll just touch upon from where the story all began. And Nifty 50 was launched on 21st April 1996, and is one of the major many stock indices of Nifty. You have Bank Nifty, you got Nifty IT, and other indices as well. But majorly Nifty and Bank Nifty are the ones that are actively traded. And NSE commenced trading in index futures on June 12th, 2000, and index options on 4th June 2001. So almost more than 15-16 years back, we had the futures and options on indices available in India. And Nifty, when we talk about Nifty, it's basically made up of 50, a basket of 50 stocks, and it's 12 sectors. So what you need to understand is that this is something which is important, is that Nifty is basically, it gives you a complete overview of how the economy is performing, because it has pharmaceuticals, it has metals, it has telecom, it has IT, it has banking, it has automobiles. So it's got all the major sectors. So there are roughly 12, there are primarily 12 sectors which are there, which form the Nifty index, and which consists of a basket of 50 stocks. And these stocks are the most diversified, and also they are the blue chip stocks primarily, because FMCG, like the likes of ITC and all that. So they are highly liquid, they are blue chips, and they have very strong and robust management. And they also are amongst the highest market in terms of market capitalization. Then apart from that, what we see in Nifty, I'm talking about now the Nifty futures or the options. You have a very high liquidity, highest liquidity you can find when you compare it with stocks. So liquidity is very high, and it's a very active instrument. So the slippage cost is very low, the impact cost is very low. Impact cost basically means your what's the difference when you're buying Nifty futures and when you're selling Nifty futures? What's the difference? So the bid and ask spread, that's very minimal. And the best part is that if you're a short-term trader, then the current month is best to trade. If you're trading futures, if you're trading options, then you ideally should trade options which are most liquid, that is having the highest OI, open interest, or slightly out of money or slightly in the money options. And the strikes that are available in Nifty options has a price has a gap of 50 points. So if one strike is 10,700, the next is 10,750, and below is 10,650. So this is the way it continues. And you have these index futures and options. You find liquidity in the far months also. There is a mid month as well as the far month also. So that's one advantage, that if you're looking at taking positions in Nifty, say for a couple of months or a few months, you have that advantage. You can take that, and the same is also with Nifty options. But that is not available in mostly in the case of stocks. So stock options, you'll find that they are liquid only in the current month contract. So now, why do people find trading Nifty so difficult? So one is that there's a lack of awareness of the dynamics that drive Nifty 50. As I said, that this index Nifty is made up of 12 sectors, 50 stocks. Now all these stocks could be pulling Nifty in a different direction, because the value of Nifty is calculated basically on the basis of the movements of these 50 stocks. So sometimes you'll find that some sectors are performing well during the day or during the week, but some sectors are not performing well. So you'll find that maybe Nifty is not going anywhere, but stock specific action you're witnessing. So that's one of the reasons why you should ideally ignore all the noise which is emanating, which is there in terms of stock specific information that is coming out while trading Nifty. So if you're trading Nifty, you don't have to look at that. More or less, you have to be concerned on the macros of the Indian economy and how the global markets are overall. The sentiments of the global markets are, because that's what majorly drives the Nifty, and it is what we are seeing is that it is, as I said, it's made up of 12 sectors. So it could move in, some of the sectors could outperform, some of the sectors could underperform, and then we could have a trendless market. Then why people also find trading Nifty difficult is that sometimes there is reduced volatility. So volatility is not much. So there's range bound trading happening. So many of the technical indicators don't perform well in range bound trading. For that, you have to have a different approach altogether, because it's just like the seasons. And apart from that, people are, or traders and investors also unable to comprehend the impact of Nifty stocks on the Nifty index. So, say for example, there is some positive news on the IT sector. So you'll find that the IT stocks have started moving, but Nifty isn't moving much. Maybe because there is sell-off happening in the automobile space or in the metal space. So the point what you need to understand is just that, just knowing the on any relevant or relevant information which could impact a Nifty 50 stock does not give you a leeway while trading Nifty. This is something which you need to really understand, because this is at times really confuses people, because they get some positive news on a few stocks of Nifty and then they feel that Nifty maybe is going to go up, but that really doesn't happen. And we could see that in spite that, because it's the weightage of the stocks that matter, and that's basically on the basis of the free float market capitalization method, which is there. So I've just put this slide here. This is the latest slide which you can look at as. So you find, if you look at this table, this was taken around 230 or so. So the futures and options, if you look at the turnover column, that is the third column, you'll find that 4,77,383 crores worth of trading actually happened since the market opened till to roughly 2:30 in the afternoon. And if you look at the index options, so out of this 4,77,000 crores, 3,56,000 is index options. That is primarily your Nifty options and your Bank Nifty options. And you have your index futures, that's roughly around 13,300. And the balance, roughly 1 lakh, is stock futures and options. So you'll find that 80% of the volume that happens in the futures and options segment is primarily only due to two instruments, that is Nifty and Bank Nifty. Nifty, what you need to understand is that Nifty, you have these monthly contracts and in futures and options, whereas in Bank Nifty you have monthly contracts, but in Bank Nifty options you have weekly contracts as well. That's one basic difference between Nifty and Bank Nifty. The lot size is also important. Nifty, if you're trading futures or options, the lot size is 75. If you're trading Bank Nifty, the lot size is 40. We'll primarily be restricting ourselves to Nifty, because if you can trade Nifty well, you can trade any stock and any index anywhere in the world. So you get a fair idea as to the sort of volume that happens on the index futures and options. That's roughly 80% of the total volume that happens. Now, the next area that we look at is what is the right way to trade Nifty. So generally, what happens is that once one really understands how to trade the Nifty futures and options, it can be very profitable. But for that, you need to have a strategy, and second, you need to have discipline. And the shorter the time span that you're trading in, the more discipline is required, because you might have to take decisions at the go, at the fly. So you have to take an immediate decision. And also, when trading Nifty, focus has to be, it could be on the cash chart, or you can say look at the Nifty futures chart also. So that really doesn't wouldn't make much of a difference. Apart from that, what matters is the market breadth. If you look at the overall number of stocks, how many of them are positive during the day, how many of them are negative during the day, that gives you us, it's basically like a market thermometer. So it basically tells you whether the market is overheated, whether the market is ripe for a sell-off, or which way the market is likely to go. So because it talks about the overall breadth. So if we are having Nifty 50 stocks, so how many of the stocks are green, how many of the stocks are red? So that gives you some clue that at times could be misleading. So you just don't act on the clue. You have to confirm it with the technicals as well. And right way also includes, as I talked earlier, that ignore company specific news while trading Nifty. It is there to confuse you, and it could confuse you significantly. And apart from that, what you really need to do is that if you're trading, this is for any asset class you trade and any stock or index you trade, as far as possible, avoid trading in the first 15 minutes of the day. Let the market settle down. Let all the news be factored into the price, and then you can take a view, and then you can take the call. What you need to understand is that there's no reason to really rush into a trade, because trades are plenty, and if you miss a trade, you'll have another trade the next day, or even the same day perhaps. So don't be in a hurry to take a trade, because that's not a good idea. Because as I talked about, trading profitably, you require strategy, and then you require discipline. And since Nifty has the highest liquidity, and technicals work extremely well on liquid stocks or indices. So Nifty is a fit case for trading technically. You have to look at, I'll talk about some strategies which you can look at, some indicators which you can look at how you can interpret. So I'll be talking about that as well. And also, what you need to understand is that you need to decide what you wish to trade, whether you wish to trade futures, whether you wish to trade options. Both have their unique features. So if you want to trade Nifty, so you have to decide first if you want to trade futures or you want to trade options, because options are a different ball game altogether. Futures are a different ball game altogether. Just to give you an example, suppose you are bullish on Nifty, and you just go and buy a Nifty futures, and say Nifty is at 10,600. So Nifty doesn't go anywhere for the next 3 4 days. So you're neither making money, you're losing money. So 10,600 remains 10,600. But at the same time, say for example, you will also buy a call option of Nifty. So and the premium that you pay is roughly 100. So that needs to be multiplied by the lot size. So the premium that you paid is 7,500. So for the whole week, Nifty doesn't go anywhere and closes somewhere in the same range of 10,600. So the premium that you paid of 100, that is 7,500, that's not going to remain as is, because you will find that the value of the premium has come down, and from 100 it could maybe becomes 80 or 70 or 60, depending upon the time that's left or the volatility that's there in the markets. So as I said, futures and options, they are unique. They have unique features, so you need to understand which instrument you want to trade. But they have their own pros and cons. You can also refer to our other webinars which are there on these features and options. And also, what you need to understand is that whether you are an intraday, you are into intraday trading, or you are swing trading or short-term trading. Intraday basically means same day square off. Swing trading means couple of days, and short-term trading means a couple of weeks. And also, what you need to understand is that trading is an emotional game. So managing one's emotions is extremely crucial for success in trading. If you are very emotional and you bring your emotions also into the market, then I would say that it will be really extremely difficult for you to manage your emotions well in the markets. If the markets don't move in your favor, and also if they move in your favor, then also. So you have to understand this, and risk management must form part of the trading strategy. It's just like a safety net for a trapeze artist. So if you have your risk management in place, even if trades go wrong, you are not out of the game, and you can still come back in the game. So that's the advantage of having risk management or money management as part of your trade. Now we'll look at now the tools that give you an edge. Which are the tools that you can use which will give you an edge, and we'll take some examples, and real life examples to explain that to you. Generally, when I'm talking about tools and for trading, it's primarily technical indicators which are there. They also called sentiment indicators, and you've got hundreds of them. I would say hundreds and hundreds of them, but looking at too many indicators can really confuse you. Can really, I would say, lead you in circles, and you might not be able to take a decision whether you should buy or sell or stay aside. So you should have some. You should use a few indicators. I'll be talking about a couple of them, few of them, and like moving averages, they are very useful, and you can use them in trending markets, primarily when the markets are in a bull trend or a bear trend. And so either the market is going up or they're going down. At that point of time, moving averages work well. You've got a short term, you can use a 10 period exponential moving average. Medium term could be a 50 and 65 period moving average, and a long term is again 100 and 200 moving average. The long term could be simple moving average, and the medium term could be as well be simple or exponential. But the short term definitely needs to be exponential because that captures the price moves in a better way, and you get the trends in a better manner. So these are some indicators which are there for trending markets. And you have something called the MACD. That's a very popular and very useful indicator. Moving average convergence divergence. So you've got also you have the histogram that is plotted. That's the best to use because that gives you a very good graphical representation as to how the market is moving. So here the parameters are 12, 26, and 9, and ideally it is below the zero line or above the zero line. Above the zero line and the bars are increasing, that's bullish signal. Below the zero line and the bars are increasing, that's a bearish signal. So I've just basically touched upon that. You can study it in greater detail. Then you would have heard of terms like overbought, oversold, and all those terms. So primarily, you are using stochastics, that is non-trending indicators like RSI, relative strength index, or the stochastics for that. And the stochastics and RSI, again, you can use a 14-day period. That's the most common and popular. For short term, you can use a 11-day or a 9-day or a 7-day or a 7 period. If you're looking at an hourly, that becomes a 7 period, 9 period. But I have found that on an average, 14 period is the best because it captures the trend quite well. And also, it's neither very fast to give you too many whipsaws, or is it very slow that you miss out on the big moves. And some people use as significant as 21 as well. That roughly corresponds to the number of trading days in a month. Then there's something called the ORB, that is the open range breakout. As I talked about earlier, is that the first 15 minutes of the day is something which is very important, very crucial. So where is the market settling in? What is the high and low of the first 15 minutes of the day? That can give you some sense of direction and some sense of measurement as to how the market is likely to behave. Then we have something called Bollinger Bands. That's a very good tool for trading. I'll show you with an example. And you can definitely, whatever I'm teaching you, whatever I'm talking about right now, you can implement all this from tomorrow onwards. And we'll also be sharing this presentation with all of you, so for your reference and your guidance. So Bollinger Bands is something very useful, very good. I'll talk about them because Bollinger Bands basically means is that 90 more than 95% of the price is between the Bollinger Bands, that is the upper band and the lower band. And the parameters, popular parameters that are used in Bollinger Bands is the 20 period. For the moving average, that's a simple moving average, and 2% standard deviation. So basically, that captures 95% of all the move. So we'll see how that works. And then there's something called support and resistance. That's again something which is psychological, but at the same time very useful. If the market is, say, taking support at 10,500 levels for Nifty, then you have to respect that level, and then 10,500 is not a good level to sell. So only if it reaches 10,500, the downside you could expect for the selling in the market, because a lot of sell stops would also get triggered, and also those who want to go short in the market, they could go short below that support level. Whereas the resistance level, if 10,800 is a resistance level, then till the time 10,800 is not taken out for Nifty, you'll find that Nifty continues to consolidate and trade. There's one point which I would like to highlight is that you should also be aware as to what is the maximum, which are the contracts in the call and put option for Nifty, which has the highest OI, that is the open interest. So currently, if we look at it, could be the 11,000 call option and the 10,500 put option. So what it effectively means is that Nifty has a very strong support around 10,500 and a resistance around 11,000 levels. So what you need to do is that you need to be aware at that point of time when you're trading as to which are the most active contracts, because that gives you some sense. And apart from that, you've got pivot levels also there, which are easily calculatable. You can calculate them, and they are easy to calculate and already programmed in most of the softwares. And they also tell you the support and resistance levels, what's valid for the day, and you can use that. We have our Angel Advanced Charting application that's available in Speed Pro. If you are interested, you can write to ebroking@angelbooking.com, which you can see at the bottom of the slide, and with your client code and a request that you need Angel Advanced Charting application to be enabled in your Speed Pro application, so that will be done. And you can also use the charts and plot these indicators. If you're already using them, nothing like it. Then we'll come to selecting a trade. Whatever approach you take, key advantage of any system is that you design it when the markets are closed and you feel calm. And a system becomes your anchor of rational behavior amidst turbulence of the markets. What it basically means is that if you have a system or a strategy or a few rules which tell you when to buy, when to sell, when to stay away from that, and that basically keeps you rational in an otherwise irrational market. In an otherwise, you find that there's extreme volatility at times in the markets. You really don't know what to do. But with technical analysis, proper guidance, with some rules which you formulate for yourself, you can really stay calm, and then you can take the right decisions. And so what we see is that basically there are three key demands for every trade. Whichever trade you take, there are three aspects which you need to look at it. One is the trade setup. You need to write down the three key numbers for every trade. What is your entry price, what is your target price, and what is your stop loss price? Before entering the market, you need to decide how much you'll pay, how much you'll risk, and how much you expect to gain. So this is something which is very crucial. You just shouldn't be just thinking about your entry point as to I will enter at say 10,500 Nifty futures and is bullish, so I'll buy. But the key question is, if Nifty corrects, then where will you exit? What is the technical stop loss? And the shorter the time frame you're trading, the smaller your stop loss will be. So the probability of the stop loss getting triggered is high. But at the same time, if you place your stop loss at the right places, the probability and the possibility and the chance of the stop loss getting triggered reduces significantly. So the trade setup basically involves your entry, at what price you enter the trade, what's your target for the trade if the trade moves in your favor, and what is the stop loss for the trade if the trade moves against you. And when you take a trade, you should be prepared for either cases, the trade moving in your favor or against you, and don't take it personally and don't let your emotions get the better of you. Next is risk management. You need to decide how many rupees you are prepared to risk on this trade. Say, for example, you're trading with an amount of 100 rupees, just to give an example. Now, if on a particular trade only, if you're risking 50 rupees, that means if that trade goes against you, you are down by 50%. So now coming back to 100 rupees, you require a return of 100% because 50 to 50 is 100%. So the point here, what you need to understand is that somewhere or the other you have to decide what is the risk that you're willing to take, and that risk should not be so big, and one loss can really make you stop trading or make you basically paranoid in terms of, or maybe fearful. So it shouldn't be that way. So ideally, you should risk limited on each and every trade. So the risk can vary between 2% to maximum 5%. And last but not the least, every single trade must be based on a specific system or strategy. So the trade has to have some reason, some logic as to why the trade is taken, because that gives you the confidence to hold on to the trade. If the trade moves in your favor, or also if the trade moves against you. So now we look at some specific examples. These are a few slides which you should definitely pay a lot of attention to, because that gives you a clear idea as to what you should be doing. And I'll be looking at different time frames, and I'll be talking about them. So, what first of all, if you are trading, if you are a short-term trader, meaning or a swing trader, that means you are holding your position for a couple of days. So, couple of days meaning 2 days to maybe 4 5 days, a week or so. So for that, you look at a weekly chart. If you're looking at a weekly chart, so the weekly chart basically tells you the trend. Here I've plotted. If you see, there are many moving averages. You have this 10-period moving average. That is the green line. The green line on the chart on the price chart is the 10-period exponential moving average. So you have to look at the slope of it, and below that we have the 20 and the 30 period. So these are also short-term, very good predictors for short-term trends. So you can see that these all are sloping upwards. This is a weekly chart. So this is your first screen, which that's called the market tide. So if you are interested in trading in any stock, first of all, you look at a weekly chart, plot a 10 period, plot a 30 period moving average, and look at the slope of the moving average, which way the slope is there, because it's the slope that is important, neither whether the price is closing above or below. It's the slope that is most important. And once you analyze, so from this chart of Nifty, this Nifty chart, we are seeing a weekly chart of Nifty. You can clearly see that the overall trend for Nifty remains positive. We have some other indicators also, like the MACD histogram, which you see that's plotted. That's also above the zero line and slightly positive. We see the stochastics, that's in overbought territory, and that's more than 80. So more or less, we see that the trend for Nifty remains positive on a weekly chart. But what you need to understand is that just looking at the trend on a weekly chart, you should not jump into trading immediately, because you will have to wait for your level. What is the right level to enter? Because otherwise, looking at the weekly chart, you find it bullish, but then you see a major correction happening the next day, and your stop loss gets triggered. This is a problem or an issue which I have seen with many traders. They look at the weekly chart and then they become very super excited about that particular stock or whatever, and then they take a trade only to find that the next day only the stop loss gets triggered, or the same the stop loss gets triggered. Because on a weekly, when you're looking at a weekly chart, the weekly movement is significantly higher. It could be 200-300 points, maybe more. Whereas if you look at a daily chart, it could be maybe 50-60 points, 70 points or so. So that's the reason the weekly chart is meant for a trend. It basically is a market. It's a screen which tells you whether you should be on the buy side, whether you should be on the sell side, whether you should stay away. If it's completely flat, then ideally you shouldn't be doing much. So this slide is, I hope it's clear. We look at the next slide. So the first was screen one was the market tide. The second is the market wave. So we looked at the weekly chart earlier. Now we are looking at the daily chart. So here again, if you look at the Nifty daily chart, or you can see for yourself that the green line which is there, the 10-period exponential moving average, that's sloping upwards, and the MACD histogram is also is more or less, if you look at this point, this also is positive. So yes, so if you look at the MACD histogram is also mildly positive. So we are seeing that the weekly trend is positive, the daily trend is also positive, and then we look at the short-term trends as to we look at an hourly chart, and we also look at a 15-minute chart as to where you can enter the trade. So you should never take a trade just by looking at a 15-minute chart or an hourly chart, because on an hourly chart things might be looking very bullish, but if you're looking on a daily chart, it might not be the case. If you wish to confirm it with the weekly chart, you find that it's not at all bullish. So you can get trapped, and you could be caught on the wrong side of the trade. So first of all, you should not look at the short term, look at the long term, because that gives you a larger picture. You have a frame of reference wherein you decide, okay, the overall trend is positive, so now I'll wait for some correction to buy. Or maybe the overall trend is negative, so any pullback I will use for shorting opportunities. So that gives you a different perspective altogether. So now we look at that how to make the right trade. We've seen earlier the setups, that is looking at the weekly chart, looking at the daily chart. So now we look at as to how to make the right trade. So here we are talking about execution. So this is the entry point. That is the third screen. So the first screen was a weekly chart, second screen was a daily chart, the third is your entry point, which is your hourly chart. So here we are looking at the hourly chart, and here we are using majorly Bollinger Bands. This is something which you can use. It can really be very helpful. So if you find that the overall trend is daily trend is positive, the weekly trend remains positive. So any correction, I had earlier mentioned about Bollinger Bands. That Bollinger Bands are very good tools, because what they do is that they contract when the markets are trading sideways, and they expand when the markets are volatile. And also Bollinger Bands, generally they have 95% of the prices within the bands, because of the 2% of the two standard deviation. So what you can see here is that this crosser which I have marked, if you look at this particular case in this hourly chart, this is of 2nd January. This is a few days back. So here you will find that this Bollinger Band, we have these two lines, the green line and the red line. So in this case, it has closed below the red line, and then once it closes back in the above the red line and in the band, that can be a good buying opportunity. So you find that roughly you buy here, and then you have to have some stop loss which has to be there, and from there you'll find that the market has rallied significantly. So this level was somewhere in the region of 10,400, 480 or so. It did correct till 10,440, and then from there it has rallied all the way to 10,760. So almost a 300-point rally in Bank Nifty has happened. So you can look at this. So this is a short-term trading, as I said, a week or so, because in a week's time only it rallied from 440, 480 levels to almost 10,680. So a 200-point rally in Nifty happened. That's roughly 2%. So you can use this strategy. So what you need to do is look at the daily trend. What is the daily trend? Look at the weekly trend. What's the weekly trend? And then you come down to the smaller time frame and hourly. So if you're a short-term trader, that is, or a swing trader, then you need to look at the hourly trade, hourly charts. So in this hourly chart, you got a trade on 2nd of January, and see where the market has moved. After that, in this band, after that, Nifty has not closed below the lower band. So that is there. And once the index, or once the stock touches the upper band, then you have to be slightly cautious, because that means that there could be some profit booking coming in the at higher levels. So then you can trail your stop loss. We'll talk about that as well. So I hope so far that is clear. Now, this example which I was talking about was on an hourly chart. But now, say for example, you want to trade short term, you want to trade from I would say a couple of days, or maybe, yeah, a couple of days or something intraday also. So here you see that this is again, I have put a 15-minute chart. Earlier we were looking at an hourly chart. This is a 15-minute chart, and we got this trade only 3-4 days back. There's on 12th we had got this trade from almost 10,630, 40 levels. You can see that it closed below this, and then this red candle closed below this lower band, and then this green candle closed above this lower band. So now this is a good buying opportunity. If you see here again, closed below and then closed above, so this again becomes a good buying opportunity, and you could really have traded here. You've not this is just a taken data till here, so you can see for yourself that this can be a very good trading strategy which you can look at. And you also have, as I said, you have to look at the long term chart, the long term trend, how it is, and then you have to take a trade. If we look at the right hand column here, we've seen that it closed below here. Your stop loss gets triggered, because if you bought here, you have a stop loss below, so stop loss gets triggered. So once your stop loss gets triggered, then you have to wait for some time. Here you can use this MACD histogram. This is something which is very good. If it is very deep, and then you wait for it to reduce in its length, then that could be a good trade for you, because here you're seeing it's very negative, and it's still the bars are very long. So this was short term, and I would suggest is that just don't go by what I say. You should look at the particular index. If you're trading Nifty You should definitely look at the chart, and you look at the put these indicators. You have this presentation also, so that will help you after this webinar also to look at the presentation as and when you want to. And if you have any doubts or queries, you can write to us and at webinars@angelbroking.com, and we'll address your query. And this can be a very good strategy for short-term trading. It really works well. If you are even a shorter-term trader, then you can maybe look at an hourly chart. Then you don't need to look at the daily chart. You can look at an hourly chart. You look at a 15-minute chart. And if you're trading index, then even you can look at a 5-minute chart, because the liquidity is extremely high when we talk about index, be it Nifty or Bank Nifty. So now the key question is, how do you set stops? Because if you have a trade, if you take a trade, then for example, you need to have a stop. So we'll just take this example. Here you find that if you are taking a trade somewhere here, so your stop has to be the recent bottom, and you'll find that this is the same level of support. So this was somewhere around 10,600. Your entry was somewhere around 10,640. So, and then the market moves in your favor. And one more thing that you really need to understand is that if the market is closing very strong, towards the end of the trading day, it could be a particular stock or index, then the likelihood of the market opening with a gap up the next day is high. So you could take that risk. If you have multiple lots, you could book profits in half the lots and trail half the lots. In futures, that is, there is one disadvantage, that if you fail your stop loss, but the next day market opens the down gap and below your stop loss, so your stop loss does not get triggered, you have to exit that position. So that's there. And so that's something which you need to understand. So where do you put stops is, first is below the recent low, as I talked about. You can use your pivot support or support one or support two as your stop loss. There are many indicators, like one of them is parabolic SAR. You can use it. That's very good for trailing. But that's what I've seen is that it doesn't work well in sideways market. It tends to be very choppy. But in strong trending markets, it can be a very good use for trading your profits. Then there are some. We have a webinar that's coming up on Japanese candlesticks this month. I think you should attend that as well. So, which talks about major bullish candlestick patterns. So your stop can be below these major bullish candle patterns, like you have the hammer or the bullish engulfing pattern, or major bearish candlestick patterns, like you have the hanging man, shooting star, bearish engulfing pattern. So if you're on the sell side, your stop loss has to be above this hanging man or shooting star or bearish engulfing pattern for a sell. Likewise, the key support and key resistance levels also can be your stops. So if you're buying, so any stop loss below the key support is good. Any stop loss if you're selling above key resistance is good. But what you need to understand is that never keep your stop losses at whole numbers. So, for example, if you're buying Nifty, and say Nifty is trading at 10,550, and you see that technically the stop loss is 10,502. So don't keep it at 10,500 and 500 or so. You should ideally keep it at 10,497, not even 499, maybe a couple of. So if you feel that the stop loss is large than your expectation, then wait for some correction to enter, so that your stop loss, you don't need to compromise on your stop loss, or you should never compromise on your stop loss, because that is your last line of defense. That is what protects your capital if the market moves against you. And don't risk more than 2% of your capital on any one trade. Some people risk 3%. Few people risk even as high as 5%. Those who are ignorant and don't really know how to trade, they risk even 30, 40, 50%, and then they blame their luck. So what you need to understand is that you need to manage your risk, and this is the way you uh, set stops for the buyers. The opposite in the case of sell trades. If you're having sell trades, so that's the way you set stops. So now just talk about on something on psychology, is that the odds against you. Trading is a battle. So when it is a battle, and when you pick up your weapon and put your life on the line, would you rather be drunk or sober? Yeah, drunk or sober is being talked about in terms of your emotions. If you're very emotional while trading, then your chances or your likelihood, your probability of winning in the market is very low. Whereas if you're sober, if you're able to manage your emotions well while trading, then the probability increases multifold. And you'll find that majority of the people are unable to control their emotions while trading, and that's the reason the market treats them the way they treat them. Then generally what happens is the mental baggage from childhood can prevent you from succeeding in the markets. If we are very fearful, or if we are very lazy, if we are indisciplined, if we are lacking patience. So if we are carrying all this and we continue to display the same character traits in the markets itself, the market is not going to help us in any way, because you need to understand is that the market is not your friend. So that's something which is important. Also, you have to identify your weaknesses and work to change. What are all weaknesses that you have as an individual, as a person, as a human being? You need to identify them and you need to work to change. The best of the best traders, the most of the successful traders have managed to overcome their weaknesses, or at least if they will not be able to overcome their weaknesses, they have somehow learned to manage their weaknesses. Then, apart from that, you need to keep a trading diary. Write down your reasons for entering and exiting every trade. Look for repetitive patterns of success and failures. If you're taking a trade, you make a small note as to why you have taken the trade. That's it. And apart from that, to be a successful trader, you need to choose a few number of markets. So here we've been talking only about Nifty. So if you want to trade short term, then don't focus on too many things. You just need to focus on Nifty and maybe Bank Nifty at most. If you're trading short term, you want to trade liquid, extremely liquid markets, and you want to trade fully technically, then these are the I would say instruments which you ideally should trade. Select a few tools, because if you're having many tools, then many tools will give you many outcomes, and that would lead to creation of confusion in your mind, and it would be difficult to take a view or a call. As I said, use at least two time frames, but not more than three time frames, because adding more only clutters up the decision making. So as I said, if you look at the weekly chart, the daily chart, then hourly chart, you don't need to go down further. Likewise, if you're looking at the daily hourly, then 15 minutes can be very good for trading short term. As it is said that too much analysis leads to paralysis. So you don't need to analyze too much when you're trading the markets. And also from a short term perspective, it's very difficult, because the time window which you have is very less as compared to a long term investor who is basically staying planning to stay invested for years, whereas a trader is there in the market maybe for a couple of minutes to a couple of hours to a couple of days, maybe, and to a couple of weeks. And lastly, trading is a journey of self-discovery. You need to understand yourself. You need to understand what your weaknesses are, because whatever weaknesses you have, the market will find them out and use it against you. So you can't win the markets until unless you learn more about yourself and how you can overcome your weakness. As I said, we have this Angel Advanced Charting tool, which is available in Speed Pro. It gives you the advantage of watching and working on the charts real time on the NSC, as well as for futures and options. So this is something that you can use. You can write at ebroking at the angelbroking.com, mentioning your client code and request for activation of this Angel Advanced chart. So it will get activated in 24 hours or so. So with this, we conclude this webinar. I hope you'll had some learning. Thank you.